So this happens to be the final class, the final section. So I'm going to try to be as quickly as brief as I can, so I can round up and so we can move further to the next section. And so the first thing we're going to be talking about today is what is forex analysis. Forex analysis. And the second one, we're going to be looking at what is trends and flats. After that, we are going to be looking at support and resistance. And we're also going to be looking at channels, and we are going to be looking at candlestick formation. So these are all the topics that we're going to be treating today. So let's start from forex analysis. So when you hear the word forex analysis, what does this mean? So in forex trading, forex analysis refers to the process of evaluating and studying various factors that can influence currency exchange rates. The goal of forex analysis is to make informed trading decisions by predicting the direction in which currency prices are likely to move. So there are two main types of forex analysis. So number one is the fundamental analysis, and then the number two is technical analysis. So those are the two main types of analysis that we have. So let's look at what fundamental analysis is. Fundamental analysis involve examining economy, political and social factors that could affect a currency's value. I'll come again. Fundamental analysis involves examining economic, one, political and also social factors that can affect a currency's value. This type of analysis takes into account various indicators, news release and events that impact the overall economic and social factor of the currency. So there are some key factors in fundamental analysis that we must know. Number one on this list is economic indicator. So let's say the data like GDP, inflation rate, employment figures, and customer confidence can provide insights in a country economic health. So number two on this list is interest rates. Central banks' decision on interest rates can have a significant impact on currency values. So let's look at the third one, which is political stability. Political events, one, election and geopolitical tension can influence market sentiment and currency value. So you can see that even when there's an election or there's any political event that's happening, that alone can affect the currency's value. So let's say, for example, when Trump was doing his campaign, I there was an attempt on his life. So That's alone, that that scenario alone that occurred had an impact on the chart. So if you were live on the market that day, you will see that USD, um, you know, there was a fluctuation in the market, so it affected the market. So that is also fundamental, So if you are, imagine if you did your technical analysis alone without looking at the fundamentals on that day, and you just see that your trade that's supposed to go the right way, because of the news, and it affected the currency, and that can just spoil and scatter your whole structure and all the strategy that you are using. It can just violate all the key levels that you have marked, and you'll be wondering why price did that. That is if you don't have an insight on the fundamental aspect of analysis. So let's the last one on this list is market sentiment. Traders traders perception of market condition can drive short-term price movement. News and sentiment analysis help understand market expectation. So we are going to be looking at the second one, which is technical analysis. So technical analysis involve analyzing price charts and chart patterns to predict future price movement based on historical price data. So let me come again on that. Technical analysis involve analyzing price charts and patterns to predict future price movement based on historical price data. This type of analysis relies on the idea that historical price movement can provide insight into potential future movement. So there are key components of technical analysis. But first, let me show you what this let me show you an example of what technical analysis is on the charts, on the live charts. So if you look at this old chart itself, this is what happened before. Like um this is what happened before, and this is the recent price action. So when price did a break of structure here to the downside, so we expect that price should retrace back to at least a premium level before it sells further. So you can see our price retrace back. So now this is our historical pattern. So I mark this place out as my order block. So I expect price to come back to this place and fill up this imbalance that is here. See, there's a gap here. So this is also my confluence. So you can see that price came to that place and try to fill up the imbalance there through this candle. So after price did that, price did a market structure shift again. So why I am trying to explain this is this was an historical event that took place, and then so that made me to mark out that place and predict that price will trace back there and sell further. So that's how technical analysis works. So let's look at like I said, the key components of technical analysis includes number one, which is price charts. So candlestick chart, the line chart, the bar chart displays historical price data visually. While number two, we have the indicators. Technical indicators, e.g., the moving average, the the relative strength index. We also have the MACD, helps identify trends. Also helps to check the momentum and also potential reversals. Second on the list, we have chart patterns. So recognizable patterns like head, shoulder, double top, a triangle can indicate potential future price movements. So the last one on this list, we have the support and resistance. So levels where price historically tend to stall or reverse, providing insight into potential entry and exit points. So let me come again. Support and resistance are levels where price historically tend to stall or reverse, providing insight into potential entry and exit. So using both types of analysis, many traders use a combination of both fundamental and technical analysis to make trading decisions. So fundamental analysis provide a broader perspective on the market overall direction, while technical analysis helps identify entries and exit points based on price patterns. So let's summarize the whole thing. So the first on the summarize section is that forex analysis involves studying factors that influence currency exchange rate. So another key point is fundamental analysis focuses on economic, political, and social factors. So the next on the list also is technical analysis uses historical price data, indicators, and chart patterns. And then the last one on this is combining both analysis can provide a comprehensive trading strategy. So you need both of them to be a professional trader. You don't have to just trade only technical. When you are trading technical, you need to consider fundamental analysis, which is very, very important as a professional trader. So now we are done with forex analysis. We are going to be looking at trends and flats. So trends and flats, certainly understanding trends and flats market, also known as ranging market, is fundamental for beginners in forex trading. These terms describes the different price movements in the forex market and can help you make better trading decisions. So let's look at the word trends. So there is in trend in forex trading, trends is the general direction in which a currency pair's price is moving over a specific period of time. Let me come again. A trend in forex refers to the general direction in which a currency pair price is moving over a specific period of time. There are three main types of trends. So as you know, we have the three main types of trend. So I'm going to be indicating what trend is on the chart. So we have the uptrend, we have the downtrend, we have the sideways horizontal trend. So let me talk about uptrend, 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 uptrend. So an uptrend occurs when the price of a currency pair is consistently moving higher over time. In an uptrend, each successive high is higher than the previous high. So when there is a break of structure to the upside, breaking the previous high, that is a clear example of an uptrend. So let me show you what an uptrend means. So this is an example of an uptrend. You can see that. So this is a trend line. You see this line that I drew here is a trend line. You can see that there is for you to know that a valid trend line, at least there should be like 3 touches of this line. 1, 2, 3, and now we even have 4. You see, so this is a trend line because internally on this structure, internally, if you switch your lower time frame, you see there's a break of structure here. This was the last high, and this guy here took out this last high, breaking it so to the upside. So that's an indication of a bullish break of structure. So it came back, it broke structure again, it came back, then it broke another structure again. So that's an example of an uptrend because it keeps breaking structure to the upside. So we're going to look at a downtrend. A downtrend occurs when the price of a currency pair is consistently moving lower over time. In a downtrend, each successive high is lower than the previous high, and each successive low is lower than the previous low. So the same thing I explained to the same thing that goes on a downtrend. Let me see if I can show you guys an example of a downtrend. Let me go to past data. Okay. So let's say this here. You see from here. See, because it's going down. So this is a downtrend. See, each eye doesn't go above, so the new eye doesn't go above the old eye. You see, so this is an example of a downtrend. So there's a break of structure here. So this eye here broke this structure to the downside, so it keeps breaking structure to the downside. So this is a downtrend. It's a short downtrend in this zone, and then price was able to break and retest, and then boom to the upside. So this is an example of a trend line, a pointing towards the downtrend. So let's also look at what we call the sideways or horizontal trend, also known as a range bound market. A sideways trend occurs when the price of a currency pair moves within a relatively narrow range. In this case, POI, which is also known as point of interest, there is no clear upward or downward movement. Instead, the price remains mostly flat. So let me see if I can show you guys an example of a ranging market. So this, when you see a ranging market, it always occurs when the buying pressure and the selling pressure are the same thing. So there is no power at the moment for price to either break or break to the upside, so it just keeps ranging. So you can see this price was ranging around this zone, just doing this thing for some time, and before it was able to break it. So price broke below here, pretending as if it wanted to come down, but it quickly reversed inside, and then it was still doing the same thing, creating almost equal high and equal low. So this is an example of a ranging market. So when you see something like this, you don't trade, you wait for it to break out of this zone before you can start to have a direction of what the market is trying to do. So by understanding trends and flats, why understanding trends and flat markets matters. So these are the reasons why trends and flat market matters. So number one reason why trend and flat um, market matter is trend tr trading, which is the first one. Honestly, is trend trading. If you identify a strong trend, you might consider trading in the direction of that trend. For example, if you see an uptrend, you might look for buying opportunities. So you always look for opportunities on an uptrend. So let's say like this one that I showed you. Let me use this other one. So so you see that um, price has been going up, breaking structure. So what you look for here is an opportunity to buy. So so this now has indicated that price I want to buy. So I will have to, but I will not just buy. Knowing where to buy is one of the is another thing entirely. So I'm waiting for price to get to somewhere around this zone, to a more premium zone, no, to a more discount zone before I will buy. So that's why I'm trading for. I'm trading here to somewhere around this zone. So I think price might come and take out this guy here, and tap me in around this zone. So let's just see how price choose to react. We can only predict, we can't control the market. So you always look for a buy opportunity on an uptrend, and also look for a sell opportunity on a downtrend. So let's also look at counter trend trading. Counter trend trading. In some cases, trader may look for opportunities to trade against the trend, aiming to catch price reversal. This is risky though, and often requires more experience. So as a new trader, if you want to counter trade, it's not advisable for you to counter trade. If you are trading against the trend. So this is only meant for pros, because it can be risky. Like this one I'm doing now, selling from here. I'm counter trading because market has already done a market structure shift to the upside, so it has indicated that price wants to start going up, at least to push it further to this zone and this zone. So but before price does that, price will have to find a way of coming down to a more cheaper, to a more discounted zone before it buys to this zone. So that's what price is trying to do, just trying to find his way down to this place before buying. And sometimes it might just go up because of fundamentals. So that's how this works. So we let's look at range trading. During flat markets, trader may use range trading strategy. They actually buy at the lower end of the range and sell at the higher end of the range. Also, let's also look at avoiding trades. Trading against a strong trend or in a flat market can be risky. Recognizing these market conditions can help you avoid unprofitable trades. Yeah. Uh, uh, uh. So let's summarize the whole thing. Let's summarize the whole thing. So number one, um, trends indicate the general direction of a currency pair price movement over time. So we also have an uptrend features higher high and higher low, while a downtrend features lower high and lower low. So a sideways trend, which is the flat market, occurs when price move within a narrow range. So I've shown you this on the chart already, so you should not find that difficult. And also, understanding trends and flat market helps you to make better trading decisions and choose appropriate strategy. So we are done with trends and flats. So let's look into support and resistance. Support and resistance. As a new trader, this should be like the first strategy that you should learn. So this strategy is a very simple strategy that you can use to just trade if you don't want to complicate things. you know Support and resistance. So let me explain what support and resistance is in forex trading. Understanding support and resistance is essential for beginners in forex trading. These concepts are key components of technical analysis and also helps you to identify potential entry and exit points, as well as understand price movement in the forex market. So let's look at what is support. What is support? Support is a price level at which a currency pair has historically had difficulty falling below. It is like the floor that represents price from dropping further. In in other words, when the price approaches a support level, it tends to bounce back up because there is no significant demand for the currency pair at that price. So I'm still going to come back to the chart and explain what support and resistance is on the chart. So let's look at what is resistance. What is resistance? So resistance is a price level at which a currency pair has historically had difficulty rising above. I'll come again. Resistance is a price level at which a currency pair has historically had difficulty rising above. It is like the ceiling, like the roof, the ceiling that prevents price from rising further. So when the price approaches a resistance level, it tends to reverse and move downward because there is a substantial supply of the currency pair at that price. So let me dive into the chart and see if I can show us what support and resistance is on any of the price action here. Resistance. So you see, you can see that the first time price got to this zone, it was not able to break this zone, so it came back. You can see, so you can either you can choose to sell from here. You sell. If you get here, you buy. If you get here, you sell. So that's an example of like, so a support area and a resistance area. So but trading support and resistance alone without having other confluences is not really a good strategy though. But if you want to keep things simple, you can start with support and resistance. It's going to be able to, at least sustain you while you learn more strategies in the forex market. So let me move further because I we have limited time. When we get to technical analysis, I'm going to be explaining further what support and resistance really means. So resistance levels are not exact price but rather zones where price movement tends to slow down or reverse from. So number two, which is role reversal. Once a support level is breached, it can become a resistance level. Similarly, once a resistance level is broken, it can turn into a support level. So in a nutshell, a broken support becomes a resistance, while a broken resistance becomes a support. So number three on this is strength of levels. So the more times a support or resistance level has been tested without breaking, the stronger it is considered to be. So the fourth one is breakout. When price breaks through a support or resistance level, it could signal a potential trend reversal or continuation. So number five is confirmation. Traders often use other technical indicators or patterns to confirm support and resistance level before making trading decision. Let's now look into how to use this support and resistance. Number one way of using support and resistance is trader might consider buying near a support level and the expectation that the price will bounce back up. While number two, sell near a resistance. Trader might consider selling near a resistance level, anticipating a price reversal. So the third one is risk management. Placing stop loss order just below a support for buy trade or above resistance for sell trade can help manage risks in case price doesn't behave as expected. So let's now look how to combine it with other analysis. So support and resistance level are often used to in conjunction with other technical tools like trend line, moving average, and candlestick patterns to confirm trading decision. So in summary, support is a price level where the price tends to bounce back up, while resistance is a price level where the price tends to reverse and move downward. So support and resistance level are not exact price, but rather it is a zone. They can help identify potential entry and exit points. So let's now look at channel, channel, channel. So I think this is the fourth on the list. So what is a channel? A channel in Forex refers to the price pattern on a chart where the price of a currency pair moves between two parallel lines. These lines are drawn above and below the price movements, forming a channel that helps trader to visualize the range within which the price is oscillating. So let's look at the types of channel. Number one, we have the ascending channel. Number two, we have the descending channel. While number three, we have the horizontal channel. So we also have the trend. So let me see if I can explain this channel. So the first one, which is ascending channel. An ascending channel occurs when the price moves within a channel that slopes upward. Let me come again. Ascending channel occurs when the price moves within a channel that slopes upward. Number two, descending channel. A descending channel occurs when the price moves within a channel that slopes downward. So the last one, which is horizontal channel. In an horizontal channel, also known as a sideway channel or range, the price move between parallel horizontal line. This suggests a lack of clear trend with support and resistance level defining the range. So using channel for trading. Channel provides valuable information for traders, which is number one, which is trend confirmation. Number two, it is for trading within the channel. Number three, breakout opportunity. This is when the price breaks out of a channel. It could signal a potential trend reversal or continuation. So we also have risk management. Placing your stop loss orders just outside the channel helps manage risks in case the price moves. So let us look at combining with other analysis, combining this channel with other analysis. So channel are often used in conjunction with other technical tools like support and resistance level, trend lines, and also indicators to make more informed trading decisions. So let's summarize the whole thing. A channel in Forex is a price pattern where the price moves between two parallel lines. So the second one is ascending channel, slopes upward and has a support line below and a resistance line above. So the third one is a descending channel slopes downward with a resistance line above and a support line below. The next one A horizontal channel helps parallel horizontal line, indicating a lack of clear trend. So the next one is channel helps confirm trends, provides trading opportunities, and identify potential breakouts. So we also have combining channel analysis with other technical tools can for comprehensive trading decision. So you cannot just use that as a standalone strategy. That you need to use other tools, you know, to make your trading decision while using this as your strategy. So that's how it works. So let's look at the last one on the list, which is candlestick formation. So certainly, candlestick formation are crucial. They are crucial aspects of technical analysis in forex trading. They provide visual representation of price movement over a specific time period. So they help traders to understand the market sentiment and make informed trading decisions. As a beginner, understanding candlestick formation can greatly enhance your ability to analyze price charts. So, what's a candlestick formation? A candlestick formation are a way to represent price movement on a chart using candlestick. Each candlestick display the opening, the closing, high and low price for a specific period such as a minute, hour, day, etc. So we all know that all these things, this is called trying to see how it plays out and it's going. Very soon I'm going to be explaining how what made me um, what made me choose to sell from this zone. So um, let's focus on the chart on the on this particular topic. Let's not just be too forward, and let me give you guys a summary of the whole um, of candlestick formation. So this is a summary of the whole thing. So number one on the summary is candlestick formation display price movement on a chart using candlestick. So candlestick formation display price movement on a chart using the candlestick, while each candlestick has a body and wick that represents opening and closing. So it also has the high and the low price. So the next one, bullish and bearish candlestick indicate upward and downtrend price movement relatively. So the next one we have the doji, hammer, shooting star, engulfing pattern, and morning star and evening star are commonly candlestick patterns. So use candlestick formation to identify trends, potential reversal, and entry and exit points. Combine candlestick analysis with other technical tools for more informed trading decision. As a beginner, practice identify and understanding different candlestick formation on price chart. See, that's why I said that you need to, as a beginner, you need to study all these things. You need to go to the chart and practice them. So once you are familiar with it, once you spot it on the chart, you are going to easily identify it. So the skill will help you read market sentiment and improve your ability to make effective trading decision in the forex market. So we have come to the end of this section. We are going to after this section we are going to enter into the technical analysis. So technical analysis involves how you can enter a trade. That I'm going to be showing you guys a simple strategy of how you can take simple trades and keeping it simple. Then if you want to dive into a more advanced um, strategy, you know, so it's up to you. Or try to make your own personal research so that you can be ahead of the class. So make your own personal research. Go online. Google should be your best friend. YouTube should be your best friend. Anything you don't understand, you can still go and make your research, and you can also drop your questions on the group, and I'll be answering all the questions. So you just need to drop it there. And I'm going to be giving you guys an assignment for you to do and carry out those assignments, and you'll be posting them in the group. So um, also, most importantly, I want you guys to make sure that you have your trading journal, so you can be jotting down important um, key words about the whole trading. So uh, I'm going to be dropping this playback on the group, so make sure that if you can still go and replay them and watch it more than once, so that you can understand and grab one or two. So thanks and good night.